Since this paper is co-authored with Gustavo, is at the Federal Reserve, the usual Federal Reserve disclaimer applies. So, what's the motivation for this paper? The motivation for this paper is that securitization theory predicts that banks should securitize assets in order to transfer risks to outside investors. And the intuition for this idea is pretty straightforward. By securitizing assets, basically banks can disperse risks across the economy, and we usually think that improves risk sharing and therefore improves economic efficiency. However, there's sort of a puzzling fact which we have observed during the financial crisis in the US, namely that many banks suffered large losses from actually holding on to securitized assets. So, in some sense, the simple question which we're asking in this paper is, well, given that the theory of securitization predicts that banks should transfer risks to outside investors, how come that banks got so exposed to securitized assets? Now, if you want to answer this question empirically, there's sort of a key challenge. And the key challenge is that the main idea of securitization, namely that it can bundle and diversify risks, the slicing and dicing of risks, makes it very difficult to determine the risk exposure of banks and outside investors' securitized assets. And that's true both ex ante and ex post. So the way we want to make some progress in this paper is we're actually going to examine one particular form of securitization. So what we're going to do is we're going to analyze so-called asset-backed commercial paper conduits, off-balance sheet vehicles, they're also often called. And these are special purpose vehicles managed by large banks. And what they do is they basically purchase and hold financial assets. So this could be mortgage-backed securities, this could be consumer loans, auto loans, student loans, a number of different financial assets. And they finance those assets with short-term asset-backed commercial paper. So in some sense, these conduits engage very much in the traditional business of banking. They're lending long and they're borrowing short. Why do we think they're interesting? Well, the structure of these conduits actually allows us to assess quite precisely the risk transfer of banks to outside investors. They're also important because they're actually a relatively large part of what some people call the shadow banking system. In particular, before the financial crisis, they were a very large source of short-term funding, in particular the commercial banking sector in the US. So total asset-backed commercial paper outstanding before the crisis was roughly 1.2 trillion in US dollars. And the financial crisis really started with what some people will call a modern-style bank run on these conduits in August 2007. So roughly a year before the Lehman bankruptcy. So one way to see that, see this run, is to just look at total asset-backed commercial paper outstanding. And what you see here, it's a little bit hard to see the dates, but it starts in 2004 and goes up to 2009, and you really see asset-backed commercial paper rising up to more than 1.2 trillion, and then you see this large fall. And the fall is due to the fact that investors in this asset-backed commercial paper, which are primarily money market funds, stopped rolling over this asset-backed commercial paper, and that's why you see this decline. So what do we find when we analyze these asset-backed commercial paper conduits? So first of all, we find that banks use these conduits to securitize assets without actually transferring the risks. And the way the banks did it is they provided guarantees to the conduits which effectively gave outside investors recourse back to bank balance sheets. And as I will describe to you, these guarantees were structured in a way to circumvent regular capital requirements. And in our empirical analysis, consistent with this no-risk transfer motive, we find that once negative news about the assets held in the conduits came out, outside investors started to exercise the guarantee, which basically meant they wouldn't roll over the asset-backed commercial paper, and this effect is stronger for weaker guarantees. Also consistent with the no-risk transfer, we find that exposed, most of the losses remain with the banks and not the outside investors. So based on this evidence, we conclude that banks basically use securitization to concentrate rather than to disperse risks, while actually circumventing capital regulation, capital requirements. Okay, so let me just go through the outline. First, I will talk a bit about the institutional background. I will tell you a little bit more about these guarantees, how they were structured. Then I will list the hypothesis which we are testing in the paper. And then I will talk a little bit about the data we are using and moving to the empirical analysis. So if you think about securitization, maybe one way to conceptualize it is in terms of this picture. So if you think about a bank is holding some assets. You can think of those as some loans and is financing those with liabilities, with deposits and some equity, some capital. Now, if it wants to securitize some assets, the original idea was that it would sell these assets to a special purpose vehicle, which then financed these assets by selling asset-backed securities to outside investors. And they're transferring the risk because the investors, by buying the asset-backed securities, basically take on the risk of those assets. However, in the Conduit securitization, it was a little bit different, and the main difference was that on top of this structure, what we found is that the banks also provided guarantees to the outside investors. And let me just describe these guarantees briefly, because there were a couple of different ones. So in some sense, the benchmark, a guarantee which wasn't used very much, but the benchmark is what we call a full credit guarantee. And that's a guarantee that the bank pays off any maturing asset by commercial paper at face value if the conduit cannot pay. So the conduit promises to pay off asset by commercial paper, but if for whatever reason there's not enough cash flow, the bank will do it for them. Now, if a guarantee is structured like that, also before the financial crisis, regulators typically recognized that this is as if the bank actually had the assets on its balance sheet and requires the same capital charges for having assets on the balance sheet. There's no difference by putting them off or on the balance sheet. So for that reason, what was much more popular was what we call a full liquidity guarantee. And a full liquidity guarantee is very similar, but it has one caveat, there's one qualifier, namely that the bank only pays off the maturing asset by commercial paper if the assets in the conduit are not in default. And if a guarantee was structured like that, then effectively up to 2004, there were no capital charges whatsoever. And after 2004, there were some small capital charges, but much less so than if you kept the assets on the balance sheet. Now, what's important is how was asset default defined? Actually, it was a function of a very slow-moving variable. So, for example, if these assets in the conduit were not rated, then that usually was a function of the delinquency rate, which is a very slow-moving variable. Now, if you combine it with the fact that the liabilities were very short-term, so median maturity at issuance was effectively overnight, it was very unlikely that any asset would be declared in default before the liability expired. And that's the reason why we say that by using this structure, effectively the risk of the assets wasn't transferred to the outside investors. Now, there are two other guarantees which I also want to describe because we will use them in the empirical analysis. Over time, they also developed a guarantee where the conduit had the option to extend the maturity for a limited number of days. And now, if the conduit had this option, it could be that the assets were declared in default. So here, there was just a partial risk transfer. And then there were also the structured investment vehicles, the SIVs, which were actually a lot in the media. They were also very similar, but they also had some subordinated capital, but they only had a partial guarantee for the assets. So again, that's why we say these type of guarantees only had a partial risk transfer. So just to give you an overview of the guarantees, so basically these four type of guarantees were employed. The full credit guarantee was effectively treated as if the assets were on the balance sheet. There were the full liquidity guarantee where there were no capital charges, but effectively there was no risk transfer either. And then there were these weaker guarantees, the extendable guarantees and the SIF guarantees. There was a partial risk transfer and there were no capital charges either. Okay, so what are the hypotheses we want to test? So basically we want to test for the fact that there was no risk transfer. And the idea we have, we basically take a very standard banking model where the bank has a risk shifting motive and you have capital regulation in order to work against this risk shifting motive. And we applied it to these guarantees, and what you get out of this are three very straightforward predictions. The first prediction is that ex ante, banks going to use these guarantees to circumvent capital requirement. This is coming from the risk shifting motive. Prediction number two is that once negative news about the conduit assets come out, outside investors exercise the guarantees. And it's going to be stronger for the weaker guarantees because there's a higher likelihood that they're actually going to suffer loss on this asset-backed commercial paper. And exposed, because there wasn't the risk transfer, almost all the losses should remain with the banks, not with the outside investors. Okay, so let me just briefly describe the data we are using for this exercise, and then I will go through each of the predictions. So the data sources are a couple of different ones. So the first one, we use Moody's Investor Service rating reports. So that's actually one of the best sources to learn about the conduits. You will not find much about these conduits in bank annual reports or 10Ks, but Moody's rates all these assets because they're sold to money market funds who usually require them to have a rating. And so from these reports, we can collect information on what kind of assets these conduits are investing, how the guarantees are structured, who is the sponsor, who is the bank behind it, and whether the conduit defaulted eventually or repaid the asset-backed commercial paper. We merge that data with data from the Depository Trust and Clearing Corporation, which is a clearing house which has data at a conduit level on prices and quantities of these conduits. So we know the spreads on newly issued asset-backed commercial paper, and we know how much asset-backed commercial paper was outstanding. And then finally, we merged that to sort of standard bank data sets. We merged it to bank's scope to get an idea about the size of the bank characteristics, and the returns of the banks, and the CDS price of the bank. Now, in terms of summary statistics, before the financial crisis, you had 300 conduits which were operating, and behind these conduits were 126 sponsors. So a lot of sponsors actually had several conduits. For example, Citibank had more than 10 different conduits. The mean size of these conduits was roughly 4 billion. So that's why it adds up to roughly 1.2 trillion before the crisis. In terms of the risk transfer, the most popular guarantee was this full liquidity guarantee. So 61% of the conduits were covered with full liquidity guarantees. Much less so was these full credit guarantees. And the weaker guarantees, the extendable and the SIFS guarantees, covered roughly 25%. In terms of the assets, what assets did they hold? Well, a lot of them did hold asset-backed securities themselves. So this would be, for example, mortgage-backed securities or CDOs. A lot of them also held receivables. Often they were unrated, so this could be trade receivables, credit card receivables. Some of them also held loans. Most of them were mortgage loans. And then a lot of them were holding a mix of those assets. Okay, so let me move to the empirical analysis. So prediction number one is that ex ante they would use these guarantees in order to circumvent bank regulation. We have some evidence on that. Let me start with the evidence over time. That's really just one data point, but we think it's quite interesting to look at that data point. So in 2001, Enron went bankrupt in the US, and Enron actually had a lot of off-balance sheet vehicles which looked very much like these conduits. So the result of that bankruptcy, there was actually a discussion in the US whether to regulate off-balance sheet vehicles differently. And in 2003, the Financial Accounting Standard Boards actually decided that they would require the consolidation of conduits. They came out with a statement where they said, well, all the risk and the rewards of the conduits seem to be with the bank, so they should be treated as if they were bank assets. What's interesting, there was a lot of lobbying behind the scenes, and in 2004, actually bank regulators in the US jointly decided that conduits would be exempted from this consolidation. So bank regulators, meaning the Federal Reserve Board, the FDIC, the OTS, and the OCC, decided, well, banks should be able to continue to having these assets off the balance sheet. What's interesting is if you overlay that with the asset-backed commercial paper outstanding, what you see is really it was growing until 2001. It was pretty much flat, and it even went down a little bit bis 2004. And once this ruling came out, it started growing again. So as I said, this is just one data point, but we think this is very much consistent with the exception or the exemption from capital regulation being important as a motive for setting up the conduits. Also, when we look at across financial institutions, the banks or the financial institutions that were doing most of these were commercial banks, which we typically think of having the strictest bank regulation. And if the commercial bank was setting it up, they were more likely to set it up with these full liquidity guarantees, which circumvent the capital requirements. And then finally, there are actually two countries in Europe which didn't allow that. So Spain and Portugal didn't allow. Spain and Portugal didn't allow for this regulatory arbitrage by putting assets off the balance sheet. And you really don't see the large banks in those countries sponsoring conduits. So again, these are actually just two data points, but we think it's quite instructive to look at them. So overall, we think this is quite consistent with commercial banks using these kind of conduits in order to get around bank regulation. Now, the second prediction is that investors are going to exercise the guarantees once negative news about the conduits comes out. So investors are going to stop rolling over the asset-backed commercial paper. What we want to use is basically an announcement by BNP Paribas, a big French bank, which announced on August 9th that it couldn't value some of the mortgage assets in some of its money funds. And what I'm plotting here is basically the spread of asset-backed commercial paper over the Fed funds rate. So this is overnight asset-backed commercial paper. So that's paper which matures in 1 to 4 days. And what you see is that basically the spread was almost zero. So actually on average in 2007 it was just 1 basis point over the Fed funds rate. It starts increasing a little bit in August 2007, right before the announcement. It increases to roughly 15 basis points and then really jumps. And that's really when money market fund investors became very worried about these conduits. You also see the same, as I showed you already, in terms of quantities, not just in prices. You see this steep decline after the announcement. Now, we don't just want to look at the first difference, so we don't just want to look at the time series. We want to also use the cross-section. So we want to look at the cross-sectional variation in the strength of the guarantees, and we think that the effect should be stronger for the weaker guarantees. So for the safe and extendable guarantees, where there was partial risk transfer, investors should be particularly worried and less likely to roll over the asset-backed commercial paper. And we're going to implement that by basically just estimating a very simple difference in difference estimator, where the outcome variable is either asset-backed commercial paper outstanding, quantity, or the spread, the price. And we regress that on a conduit fixed effect, on time fixed effects, and we are interested in the coefficient on the interaction of the after variable, after the announcement, with the type of guarantee. And in some of the regressions, we're also going to control for sponsor time fixed effects, which are going to sort of soak up all the variation over time across sponsors. Now, if you look at it non-parametrically, you can already see the result. Basically, the conduits which were able to continue to roll over, the conduits which have the full liquidity guarantees or the full credit guarantees. So you see those. Full credit guarantees also declined a little bit. This was partly because there were some sponsors other than commercial banks, but they clearly did better than the extendable and the SIF guarantees. And effectively, here we're just putting that into regression framework. So the first regression shows you that if you put in a regression, you really don't find any difference between full credit guarantees and full liquidity guarantees. But the extendable guarantees and the structured investment guarantees have a large negative coefficient. So that means they decrease much faster than the other guarantees. And we put in the sponsor time fixed effects. So that's effectively saying we're just identifying off the variation within a sponsor at a given point in time. So think, for example, of Citibank, which has 10 different conduits with different guarantees. So we're just comparing those within Citibank. And even then, I mean, the statistical significance of the result decreases, but the point estimates are quite similar. We also control for the type of assets in the conduit. So the one thing we might be worried is this is actually picking up the quality of the assets and not the guarantees. So for example, it could be that structured investment vehicles were covering worse assets, and that's why we find these results. So we control for interactions of asset categories with after. And you get what you would expect. So mortgage loans, conduits which are primarily having mortgage loans decrease more. Conduits which have receivables, which were not really that affected by the announcement, do better. But the point estimates don't really change. So we don't really think that the guarantees are just proxying for the assets. We have similar results for the spreads. I just want to show you the graph here. The regressions are in the paper. Basically, you see that the full credit and the full liquidity guarantees, you see an increase in the spreads for all of them, but the increase is larger for the extendables and the structured investment vehicles. However, also in the regressions, we don't find that much of a difference between extendables and full credit and full liquidity. We find a large difference for the structured investment vehicles. So for the extendable, it seems that most of the effect was on the quantity margin rather than the price margin. Okay, so let me just move to the third prediction. The third prediction is that ex post there was no risk transfer. And we're looking at that in two ways. So first of all, we look at whether any of these conduits actually entered default. So we take the position of an investor who was holding asset-backed commercial paper before this crisis in August 2007, and longest possible maturity is 1 year. Usually it's 30 days or less, and we're just going to examine whether conduits defaulted in the subsequent year. And what we find is that out of all the conduits, only 2.5% of asset-backed commercial paper actually entered default, which means that investors had to go out and liquidate the assets themselves. However, if you look across guarantees, you see that the ones covered with full liquidity and full credit guarantees, there wasn't a single default. Okay? So there really was exposed, there wasn't risk transfer. There were some defaults for the ones structured by extendable guarantees and the ones for structured investment vehicles. But even for structured investment vehicles, most of them were able to roll it over, so most of the investors actually didn't suffer any losses. We tried to estimate the losses from these conduits. That's a little bit difficult, but because we don't know the loss rate on the assets. But we used some announcements by Citibank and State Street on what losses they had on their conduits assets. And we estimate that roughly the banks suffered a loss of about 204 billion on those assets, whereas investors, so primarily money market funds, just suffered a loss of roughly 5 billion. But these numbers really change a lot depending on what loss rate you assume. But the main point here is that most of the losses remain with the banks, not with the outside investors. Finally, we look at it in one other way. Basically, we examine bank stock returns around the announcement of BNP Paribas. So the idea is that if this is negative news for the banks, we should see that bank stock returns go down, and the effect should be stronger for banks which have a lot of conduits. So we basically look just in a 3-day window around the start of the financial crisis. We estimate a very simple regression where we regress the stock return during this 3-day window on conduit exposure, which we measure as total asset-backed commercial paper relative to the size of the bank. And what you find is, as you would expect, that if there's more exposure, then the stock return over that period is lower. Now, we have to control for the size of the bank because that really makes a difference, because larger banks did worse during that period, and they're also more likely to sponsor conduits. But once we control for the size of the banks, all the other controls don't really seem to matter for the coefficient of interest. Okay, so let me just conclude. What we show in the paper is that banks use conduits for what we call securitization without risk transfer. And we feel that a very important motivation for setting up these conduits was really to circumvent capital requirements. Now, I should point out, we think this wasn't the only way to circumvent regulation. We think this is also just one example of bank taking risks with securitized assets. There are other ways. For example, a bank could just buy AAA rated assets or sell CDS on AAA rated assets. But we think this is one example where we can actually document it quite nicely. And sort of one thought I want to leave you with is we feel that some forms of securitization, definitely not all, but at least this particular form of securitization, can really be explained by a model of bank risk shifting, wanting to take on this kind of risk, systemic risk, rather than a model of transferring risk to outside investors. Thank you.